Good morning, traders and investors. My name is Roger Scott, and I'm still the senior strategist for WealthPress. Today's Monday. It's December 19th. This is the second to the last week of the year, and we've had 2 down weeks. Let me brief you on what we should be expecting, what the highlights are this week. First of all, number one, be very, very cautious. Volume is going to be very squirrely this week. It's a holiday week. A lot of institutions are going to be taking time off, especially going into Christmas. Retail trading typically does not sustain itself. In other words, the moves that occur during the market hours are not sustainable. So usually when you see retail traders, they tend to push stocks and indices towards very, very interesting turning points, and then they back off. In other words, there's no follow through. That's one of the biggest downsides that happen right here, actually. Let me show you. No follow through. And it can be very confusing for the market. Let me just go ahead right here. See that? That's retail traders taking the market higher and then no follow through. We break lower. The bottom line is this. Be very, very cautious and don't be too fast to react to breakouts or breakdowns because there's not going to be a lot of follow through this holiday season. Seasonality. Now, a lot of people are expecting a Santa rally. I don't think we're going to have a Santa rally this year, and I'll talk about why during my analysis. Another major report that's coming out this week is the housing start building permits, something we need to pay very, very close attention to. Another major report is consumer confidence. That's coming out this week as well, right here on Wednesday. So we got housing starts, consumer confidence, existing home sales, and GDP. Big report. So I don't think we're going to see a lot of trading action unless there's something really crazy going on in the market. So again, I wanted to tell you those are the 5 themes. You got the volume, you got seasonality, you got housing starts, consumer confidence, and GDP. Now let's talk a little bit about what to expect based on what happened last week. And I want to show you guys some very important levels on the bond market that I'm seeing right now. And also, if these videos have helped you stay out of trouble the last couple of weeks, post some comments. Oh, look at this. This guy drinks bai too. I'm not the only one. Look at that. He's a bai drinker. If you guys like these videos, post comments below this video. Post them in the YouTube channel, in the WealthPress YouTube channel, and I will respond to them. So, U.S. benchmark indices slid for a third successive session and suffered a second consecutive week of losses on Friday as a hawkish tone for the Federal Reserve and soft economic data bolstered investors' fears about a recession. Folks, we are already in a recession. In Friday's session, all the indices were lower, with the prospect of a Santa Claus rally in the markets this year diminished as the majority of global central banks adopt a tightening policy. In addition, New York Federal President John Williams said on Friday the tight labor market and other factors are likely to keep price pressure elevated, cementing high interest rates for some time. Williams added that he does not expect a recession due to the Fed's aggressive tightening. Of course not. Why would the Fed's aggressive tightening cause a recession? What an idiot. Data on Friday revealed that U.S. business activity slumped further in December as new orders dropped to their lowest levels in over 2.5 years, but easing demand helped curb inflation. I've read that China's orders for China are down 40% from the U.S. That's huge. Prices of interest rate hikes priced into the market, and I think we're going to see this number increase and this number decline in the next coming days. But 0.25 is right now at 73%, and 0.50 is at 27%. And we'll see what happens. But if the market stays calm, it'll probably be 0.25. If the market still keeps seeing what we're seeing now, the odds of the 50 basis point hike will be increased. This week, as I mentioned, we've got a lot of data. You've got consumer confidence, existing home sales, crude oil inventories, GDP, initial jobless claims, durable good orders. Everything is being thrown at us, and it's a holiday week. So when you have a lot of data, that could stimulate the market, but you don't have a lot of participants. So be very, very careful because volume is subdued, and when volume is subdued, moves are not sustainable. European equities notched heavy losses last week after the European central banks eased the pace of its interest rate hikes, but signaled significant tightening ahead to fight elevated inflation. But thankfully, their interest rates are positive now. Shanghai today closed sharply lower after rising COVID cases. In the country's offset commitment to the government support economic growth, The country's facing unprecedented surge in COVID infections. This is not good. After the government scaled back several lockdown measures earlier in this month. That's bad, 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 because remember, they're the biggest exporter. And if they're doing things, if they're not rocking and rolling, how is US going to get parts for things that are in demand? It's a big cluster, you know what. The Nikkei in Japan closed lower amid speculation that the Bank of Japan could tighten its ultra-loose monetary policy. Media reports said that the Japanese government could revise a decade-old accord with the Bank Japan over the latter's 2% inflation. Tesla's going to be in play today because the stock rose over 4% on speculation that the company could announce their Mexico EV plant this week, which would be very interesting. Catalent, a stock that I've been short or talking about shorting, is also down 1% pre-market. You're welcome. That was one of my picks for last week for Friday. I want to show you guys something interesting. This is the bond market. This is intraday chart of bond market. We're looking at a monthly levels. I want you guys to see something. The low, the swing low right here is at 106.25, right? That's based on the recent trading action going back about 2 weeks. This is about 2 weeks. So I want you guys to see the low here. See, it's at 106.21. Now look at the pre-market number. 105.69, 105.69. That's right here. That takes us all the way down here, which means we're going to open more than likely below a 1 month low. Let's look at daily now. If you look at that daily chart, that means we're going to break these levels and continue coming down, as I expected this to happen. Now, if we start coming down further in the bond market, it's going to put pressure on specific sectors of the economy, like tech, technology, consumer discretionary, infotech, and those stocks are already beaten up. Now, I want to show you something interesting in light of that. Here are the 11 sectors, and healthcare, industrial, consumer staples, materials, utilities, it's finally looking like it's supposed to. You've got all the defensive, even energies and utilities are next to each other, but energies needs to come up. But the bottom line is, look at this, healthcare, industrial, consumer staples, material. We're as defensive can be. And even real estate is above. The only thing that's missing is technology still above real estate. That should go the other way around. But I digress. But if you look at the charts of everything, healthcare looks like it's bottoming out. Industrial looks like it's ready to go a little higher. Consumer staples looks like it's ready for a bounce. Material looks like it's ready for a bounce. Technology does not look like it's ready for a bounce. Let's see here. Real estate does not look like it's ready for a bounce. Communication services and consumer discretionary do not look like they're ready for a bounce. So it'll be very interesting to see if consumer staples, industrial, and materials start really gearing up for the New Year's or not. I think we're also going to see some upside in the energy sector when we couldn't break the low yesterday from a 1 week, which is a very, very positive sign. But in terms of overall momentum, and this is something you need to pay attention to, we right now have, let's see here. Who moved my cheese? Let's see, here we go. 20-day breakdowns. You have 340 stocks breaking down as of last Friday. Only 36. Typically, this number doesn't bottom out till we get to about 500-600. So we still have some downside. And I really want to see how the market's going to trade after it opens. Remember, we're sitting at the 200-day moving average, and I'm expecting us to break that level. Momentum levels, I want to show you this. Remember how all this was green, and this was really green, and this was green? Well, look, not green anymore, not green anymore, not green anymore, not green anymore, not green, not green, not green. All the foundation is moving out of the market. And look at this, S&P 500, 47% of stocks trading above the 200-day moving average. Remember this was at 90th percentile 2.5 weeks ago? It's at 57th now. How about the Dow Jones? 66 instead of 95, and it's still going lower. And folks, only 48% of stocks are trading above the 200-day moving average. In the Russell, it's 34% in the Russell 2000, ouch, and 37 are above the 200-day. So I don't know what you're thinking, but if you're thinking this is a bull market, I got something to sell you. Look at how much we're going down, and I think we've got a lot more to go. Now, this should not be a surprise because I've been talking about it since we were up here. Now we're about halfway down, and we've got a lot more downside to go. Keep your eye on the bond market and keep your eye on the sectors, major sectors today. because you're going to see a lot of volatility and a lot of directional, very, very non-directional movement, which will be very important because you have a lot of retail traders and a lot of the hedge funds sitting on the sidelines. So it's going to be a really, really important time. Now, in terms of stocks that are still leading, I want to show you something. You still have the energies, the healthcare, they're still leading. The defensive stocks are still leading, and I'm not seeing any major change there. And if you flip this over, the speculative stocks are still lagging, like that Catalent I suggested, CVB, Generic, PayPal, Tesla, Dish, oh boy, Dish, Charter, Under Armour, Seagate, Salesforce. These are not pretty stocks right now. So again, expect much of the same. Expect a breakdown, a further breakdown in the bond market. Expect momentum levels to decline. Matter of fact, let's look at all stocks trading above $2. 37%. Remember, beginning of last week, this was at 47%. Now it's at 37%. And you have 45% of stocks trading above the 50-day moving average. So a lot of traders thought we were going to go green, green, green. But look, all red, getting red. And trust me, this is going to get red sooner than later before it goes green. The market needs to go lower before it goes higher. Now, looking at volatility, let me show you volatility here via the VIX. Volatility is not going higher, which is a positive sign for the bulls. But I'm telling you right now, we went up to a 1-month high, and I think volatility levels are going to start increasing again. Now, folks, before I let you go, this is going to be a very, very dangerous week. We are near very critical levels, especially intraday on the bond market. Matter of fact, look at this, 105.69. That's right here. That's below this entire trading range, and that looks like we're filling this gap over here. And if that happens, that's going to create higher yield on interest rates. Bond lower, higher yield on interest rates, more pressure on the market going into the holidays. Not a lot of institutional traders. Very, very easy to manipulate the market right now and get traders to believe that there's a rally coming in our way. I'm not buying it for 1 second, and either should you. I would be fading the highs right now. We are setting ourselves up for more downside pressure. We need to correct, and this momentum level needs to come down to the base. Look, when we went up here, look at how far it went down. We're not there right now. When we were here, look at how far it went down. When we were here, look at how far it went down. Every time. So don't be a hero and start thinking that this is a pullback and it's time to go long. We're not there yet. Now, with how unpredictable and how volatile markets have been lately, it's been tricky to trade, even for the pros. And that's why I love my quantum indicator. It signals long and short trades, and which is very, very necessary in this market. The indicator allows us to quickly scan for stocks due for a pullback or a bounce. And it's a great way to get a measurement of the broad market. Now, I'm going live on Wednesday at 1 p.m. Eastern Time. That's December 21st. Today's Monday, Wednesday, 2 days from now, 1 p.m. Eastern Time. That's Eastern Time, to show you how it works, what it's signaling, and how you can add it to your trading toolbox. But you must click the link below, enter your email to reserve a spot, and you'll be taken to a video with more information about the quantum indicator to get yourself ready for Wednesday. You don't want to miss this session. This is my last session before Christmas holidays. It'll be a lot of fun. You don't want to miss out. And use the quantum indicator to get ahead of this crazy market that we're in right now. It's been giving us a very clear signal of where to go and what to avoid. And if you can use it with the CSI scan, which I will discuss in great detail on Wednesday, you will be so far ahead of the crowd you don't even know. You guys have a great session. Remember, Wednesday, 1 p.m. Eastern Time, Quantum Indicator. It's going to be a lot of fun. It'll be my last blast before holidays. And if I can get my hands on a Santa hat, I may wear that too. Ho, ho, ho. Folks, follow the link below. Don't miss out. Make sure to like this video, subscribe to this channel on YouTube, and comment below my videos. Bye, guys. I hope you're setting yourselves up for a great, great New Year's. Bye.